Hello everyone and welcome to the section discussing M&A transactions. Maybe you've heard about M&A, maybe you want to work in investment banking or private equity, or even if you're going to a big four, your consulting role, maybe you want to work in transaction services or management consulting, or even if you just want to go into a corporate finance role, M&A is going to impact you in some way or another. Some where it's almost entirely all of your job, like investment banking, private equity, big four transaction services, etc. And some where, it's good to have an understanding and it may impact you. For example, your company might be acquired or acquire another company. Even if that doesn't happen, it's really good to have an understanding of M&A, why it's important. Because those who do understand M&A really understand the big picture about companies. To do an M&A transaction, you need to understand, valuation concepts, the strategy, why are we acquiring companies? What are the key strategies which drive it? Why are we doing that? And these are the things that are really important to, those top level executive and management teams. So it's important to be across that, but also just around kind of valuing the business, understanding the industry that you're looking at. So really understanding industry knowledge, how do you differentiate the companies within that industry? Like how is that company placed within different companies, so that really understanding the industry knowledge behind that. And then I guess the valuation concepts as well. So, understanding, DCF, versus comps analysis, understanding multiple arbitrage there as well, but also how, acquisitions are, structured. For example, if we're doing a valuation based on a multiple of EBITDA, it's important to know that, because then you know what the levers to drive. Because if you're going in the company, how you're going to get promoted is if you understand those levers and actually actively encourage growth of those levers, people are going to notice you in that business. So it's really good to understand M&A, for many, many, many different reasons, but most importantly because it's going to give you a really good understanding of how companies work, really. So let's jump into the first slide, which is about, before we jump into M&A, let's talk about kind of how in general do companies drive value creation, and why are we starting from this? Is because it's first of all, it's top down. You're thinking from a shareholder perspective, someone who owns a company, or from the board, or from the CEO. This is the primary thing that they're thinking about. As we go down the driver chain and get down to the bottom and start talking about, customer growth and, pricing and things like that, they're all drivers which ultimately lead to value creation. Think about it from this perspective. If you're a private equity firm and you're buying a company, you want to know, okay, how do I grow the value of that so I can sell it, so I can get more money back to me, so I can buy another yacht for myself, right? That's value creation. In a listed environment, it's shareholders as well. Shareholders want to get a return on the money they've invested in this public company. So that's why value creation is really important. So what drives value creation? So it's driven by four things. Number one is organic revenue growth. So organic, when we say organic, it essentially means, without any acquisitions on top, how is that company growing year on year? For example, Coca-Cola might be selling, additional Coke cans every year. Maybe it's going into a new market. Maybe it's releasing a new product. That's just your growth of revenue versus last year. So second is return on capital. So this is especially relevant today because, the US Federal Reserve is printing huge amounts of money. It means a lot of investors have a lot of cash sitting around, and it's getting harder and harder to deploy that capital and get a return on that capital. So that's the second way of actually creating value. The third way, or the third lever of value creation, is sustainability of performance. And this one is, often overlooked, right? People often focus on number one and number two, which is revenue growth and return on capital. But sustainability of performance is really important as well, because you can buy a company, it might be growing really well or growing historically really well, but then is it going to be around long term? So think about Kodak, for example. That would have been at some point in time, especially in the 80s and 90s, a super high growth company. But look at today, it's essentially, have you heard of Kodak lately? So, we also need to consider how that growth is going to look in 5 years' time, 10 years' time, 20 years' time, even 50 to 100 years' time, depending on some certain industries as well. And then finally, just ability to manage risk. We don't want anything going wrong in the company. For example, a large lawsuit, or potentially infringement or some sort of environmental issue, things like that, which could put our value of our company at risk. So for example, do you remember when BP had that massive oil spill? That severely impacted the value of the company, the value to shareholders, etc. So, but for the perspective that we want to focus on, or the driver we want to focus on for this presentation, is probably number one, which is around revenue growth. Now, the issue that a lot of companies are facing, especially for mature industries, so, your manufacturing, a lot of service industries, your oil and gas, is how do you actually get growth, right? Because yes, if you're working in a tech company, you might be getting double-digit, revenue growth, or even higher than that every year, and that's part and parcel of the industry. But for almost every other industry, revenue growth is really, really hard. So it's a huge challenge for companies operating in mature markets, and for many companies, the growth or the growth of revenue is just in line with inflation in many instances. Think about Coca-Cola, for example. They're already in almost every country in the world. They've already released a huge amount of innovative products, and how far can you really push Coca-Cola sales any further? So their revenue growth getting above 3% is very rare. It's really just in line with population growth and economic growth. So research shows that companies drive growth through three primary sources. So number one is portfolio momentum, number two is market share, and number three is mergers and acquisitions. So what do these three actually mean? So portfolio momentum, so that's probably closest to the example I gave you before. So Coca-Cola, they're already in every market in the world. They've already got majority market share. So all the growth that they're getting is essentially population growth and GDP growth, so people spending more, right? That's really what's driving it. So the other way that companies can drive growth is market share. So this isn't assuming any actual growth in the size of the market. It's assuming the size of the market stays the same. But can we take some of our competitors' market share? So for example, Coca-Cola, can we steal some of Pepsi's sales? So the market's still, $100 billion a year or whatever it is. But instead of us being, $50 billion like we were last year, we're going to steal $5 billion of Pepsi's sales. And then the last one is mergers and acquisitions. And this could be close to number two, market share, or it could just be allowing us to go into a completely new industry. So what this is regardless of organic growth, because you could still be acquiring a slow-growing company, but if you're a $100 billion revenue company and you buy another $50 billion revenue company, even if they've got 0% growth, you've then, at least on the accounts, grown your company by 50 billion. So that's a 50% growth rate. So that's why we often talk about revenue, saying we differentiate between organic growth and total growth or revenue growth, including acquired growth. Because it can often tell a very misleading story if you've got a 50% growth rate, dig into it, and you're like, oh, actually, they're only growing at 2% a year. So these are the three drivers. And McKinsey's done a survey on this or study on this, and they've shown that in the company or the sample of companies that they've looked at, which had an average growth rate of about 8%. Now, this isn't all companies, it's just those within the sample size that they did. So they had an average growth rate of 8%. They looked at those companies and said, okay, well, of that 8%, 5% of those companies came from momentum. So that's, the actual market size that they're operating in. So the total addressable market actually increasing by 5%. Then another 1% growth, it's actually 0.5%, but it's rounded up, came from companies stealing market share from another company. And then finally, the differentiator, but to the 8%, was that they had M&A, so the acquired growth. So they didn't have M&A in this situation, then the company would have only had 5.5% growth rate versus 8%. So in order to drive that long-term value creation for investors, companies, there's a lot of incentive for boards, for CEOs to drive M&A, especially when, for example, CEOs' bonuses are based on hitting certain growth targets. So there's a lot of drivers and forces towards M&A, which is why times like this, we're hitting peak levels of M&A transactions. So what about the strategy behind M&A? Because you may have heard this before, but a bad acquisition can actually destroy value rather than create value. And this is probably more common than you think because of the drivers we mentioned before in terms of CEOs wanting to make a name for themselves, CEOs wanting to hit bonuses, etc. So there's probably a lot more pressure to do acquisitions than there isn't to not do acquisitions. But here are 6 essential strategic reasons to do M&A. If your reason to acquire a company is outside of these, for example, it's just a vague concept like we want to achieve growth or we want to achieve strategic positioning, you may actually destroy value in your company. It's really important to specifically define why you're doing an acquisition and whether it falls into one of these 6 archetypes of acquisition, which we'll go through in more detail in the next slide. But broadly, what they are is, number 1, to improve a target company's performance. Number 2, so that's you're acquiring a company which is underperforming and then you fix it up over time. You've therefore created value there. Number 2 is consolidating to remove excess capacity from industry. This is particularly common in mature industries, for example, manufacturing. When you've got a lot of factories and they're not at peak production, it's a lot easier just to take out a competitor rather than create new demand. Third is accelerate market access for the target or buyer's products. So maybe you're merging with another company which has good distribution, and therefore you're creating new revenue, which we couldn't do before. Number 4 is to get skills or technologies faster or at a lower cost than what they can be built. So this is very common in the tech sector. Anything with a skills shortage or a kind of a product side, which it's easier to acquire it rather than build it yourself. It's a good reason or a good way of creating creative value through M&A. Number 5 is exploiting a business's industry-specific scalability. And number 6 is picking winners early and helping them develop their businesses. So almost like venture capital, but you can do it from the perspective of a trade sale as well. If you're operating in a particular industry and you know which companies may do well, which won't. So let's do a deep dive into each of these in the next slide. So the first one is improving target companies' performance. And this one is especially common in private equity, but is also common elsewhere as well. So you might be able to do that in a trade sale. So for example, a pharmaceutical company acquiring a low-performing pharmaceutical company because the company acquiring has very efficient operations and thinks they can extend it to the second company. So put simply, you buy a company and you radically reduce costs to improve margins and cash flows in the company you've acquired. So keep in mind, because we need to improve the target company, it's a lot easier to do this with a company which has bad performance, so low margins, low returns on invested capital, versus a high margin, high ROIC company. So might be a couple of red flags if you're doing this acquisition for that purpose and you're acquiring a high margin company. Okay, so next strategic reason for M&A is consolidating to remove excess capacity from industry. So as industries mature, they typically develop excess capacity. So the combination of high production from existing capacity and new capacity from recent entrants often generates more supply than demand. So think about manufacturing. Think about China, how many factories they've got, new factories coming on board all the time. Every year you've got new supply coming on, and demand isn't necessarily keeping up with that. So manufacturing companies, their profitability is very much dependent on, how much of their production capacity is online at any given time. So rather than creating new demand, companies often find it easier to shut plants across the larger combined entity, resulting from an acquisition, than to shut their least productive plants without one and end up with a smaller company. So next point is accelerate market access for the target or buyer's products. So let's say you're a small company, you've created an awesome product, and to grow rapidly, you need to enter new markets. You might have trouble doing that by yourself because you don't have the know-how, you don't have the skills, you don't have the money to invest, you don't have the infrastructure and distribution channels. So in that instance, it might make sense for a larger company to acquire a small company so that they combine some of those things, maybe the distribution channel of the larger company, and the larger company is able to grow the revenue of the smaller company quite quickly as a result of that. So an example of this is IBM, who historically, they've acquired companies for not not a small amount of money, but by pushing the products of these companies, which are tech companies with software, etc., through IBM's established global sales force, IBM estimated that it was able to substantially accelerate the acquired company's revenues, sometimes by more than 40% in the first 2 years after each acquisition. So the fourth M&A strategy is to get skills or technologies faster or at lower cost than they can be built. So let's say you are a tech company, and this is a common strategy employed by a lot of tech companies, including Microsoft, Apple, etc. So if you've got a product and you want to make your product stickier, you want to add capability, drive in new customers, instead of building a new capability, maybe there's a company out there who you can acquire and you can just quickly bolt it on and improve the value of your product. You could also do this with staff as well, right? Because particularly in industries with a very the shortage of key supplies, which is another common issue in technology. So Apple, etc., often buy companies just to get their employees, and they'll value those companies based on a certain value per employee, just because it's so much easier to do that than actually go out and hire those highly skilled niche employees. So many tech companies buy other companies that have technologies they need to enhance their own products. And they can do this because they can acquire the technology more quickly than developing it in-house. And some of the other benefits of doing this might be to avoid royalty payments on the patented technologies, to keep technology away from competitors. And it's just cheaper and easier than doing it in-house. So an example of this is Apple bought Siri. So you've all got Siri on your phones. You'll probably use it a lot. You probably didn't know that they bought it in 2010 because it was a better product than probably something they could have built in-house. And they also wanted to take their competitor off market and keep it away from other competitors like Samsung. So the fifth reason for M&A is to exploit a business's industry-specific scalability. So economies of scale are often cited as a key source of value creation in M&A. For example, you might have two small companies who both purchase, let's say, sunglasses. Now, the larger the company is, the more negotiating power, and this goes back to Porter's 5 forces. You might have read about this in university, but we'll touch up on that in another video. So one of those forces is the company's ability or negotiating power over suppliers. And the larger a company is, the more negotiating power it is going to have, simply because, the suppliers don't want to lose this account, because now it's, 10%, 20%, 30%, even 50, 60% of the supplier's revenue, depending on how big it is. So they're able to negotiate better terms so they don't lose them, so the supplier doesn't lose them. But the flip side of this is we have to be very careful in justifying an acquisition just on economies of scale, especially for large acquisitions. The reason being is if they're already large companies, for example, two very large airlines, they're probably already operating at scale. They're probably already leveraged all the cost savings they already can. So just be very careful about that if they are at scale. It's different if they are small companies that you're acquiring, or if it's a large company acquiring a small subscale company, then you can actually create quite significant economies of scale. So the last M&A strategic reason is to pick winners early and help them develop their business. So it's not too different from venture capital, but often this can be done within trade as well. So for example, Johnson & Johnson purchasing orthopedic device manufacturer DuPuy in 1998 when DuPuy had $900 million of revenue. But by 2010, DuPuy's revenues had grown to $5.6 billion, which is an annual growth rate of about 17%. So how much of that was actually driven by, one of the other points above? For example, Johnson & Johnson going in and improving the target company's performance. Maybe it's from, point 3, which is actually being able to accelerate DuPuy's revenues by allowing them access to J&J's distribution, etc. Hard to say, but this point is really about where I've identified a really good quality company. It's probably not going to grow for some time, but we're investing early because we believe in it. But there are a few caveats. First, it must be a long investment. You need to make these investments early in the process, and there's a higher risk of failure, just like with venture capital. Okay, so that's the end of the first video. There's a short video just talking about why we're doing M&A. In the next sections, we're going to be talking about, once we've actually identified an acquisition and we're satisfied that it actually fits in with the strategy of the M&A, what is the process of M&A? How do we value it? What are the next steps, etc.? So we can do that in the next video. I'll see you then.